Every landlord fears a leaking roof or a broken pipe, not because of the nuisance that they cause, but because of the high repair cost involved in restoring them to their original status. Now, there is one repair cost that is far more devastating, far more expensive, and far more involving than anything that your tenant could ever break. And these are the repair costs that you misclassify. Why? Because that mistake has the potential of inviting KRA to you, and they will come loaded with heavy penalties, fines, and interest. Because when you misclassify a capital improvement in your house, in your building, and think of it as an ordinary mere repair expense, what you are doing, you are inviting KRA. What could be thought as a mere harmless mistake, in fact, it is not, because that misclassification makes you to distort the financial statements, underreport the taxable profit, and eventually pay less taxes. There are two types of repairs, ones that are referred as operating expenses and those that are classified as capital expenses. Operating expenses are those expenses that you incur on a day-to-day basis as a landlord in order to maintain the usability and the functionality of your building. For instance, when you repair a leaking roof or tap, when you repair a broken door or replace the door lock that is not functioning, or you decide to repaint your apartment once a tenant moves out as you prepare for a new tenant to move in. All those repair works are operational in nature because they are not supposed to enhance the value of your building. They are not supposed to increase the useful life of that building or even to increase the usability or the capability, functionality of your building. And therefore, you should recover all these costs during the same year of income that they are incurred because they are operational in nature. However, there are those other repair works that are value-adding, that have the capability of extending the useful life of your property or increasing the functionality and usability of your apartment. Those ones are referred as capital expenses, and they are not supposed to be recovered 100% in the same year of income that they have been incurred. Think of it like replacing an entire roofing system. Just because of a small leak, you decide, I will not only address this leak, but I will completely overhaul the roofing system. There is a wiring problem in your house, and instead of just trying to sort out the area that has a problem, you decide to change the entire electrical wiring system in your house. There's a leakage somewhere, and instead of just addressing that leakage, you decide to replace and overhaul the entire plumbing system. Maybe a tenant has moved out and all you are needed to do is to repaint the floor. But now this time around, you decide to tile it up. Or there is a problem with the kitchen wooden top. Perhaps what you need to do is to remove that section of the timber that is rotten, but instead you replace it with a granite top. All those are major improvements that are supposed to improve the value of your property, extend the useful life of that property, and enhance the performance, the usability, and the functionality of your apartment. And more so, you are even likely to add more rent on that. Why? Because the apartment looks better, is more user-friendly. Those expenses that are capital in nature, you are not supposed to recover them 100% in the same year of income that they have been incurred. Instead, you are supposed to use the existing wear and tear schedules to recover such cost over time. However, I understand that many landlords make that mistake of confusing capital expenses as operating expenses. And when KRA does realize that, the first thing that they do is to disallow those expenses. Number 2, they add those expenses back to the taxable profits. And number 3 is that they recompute the taxes payable. And by the time they are going to step number 4, they hit you with more penalties, more interest and fines. And at the end of the day, your tax invoice balloons. What was once a mere repair item becomes a major cost that your business has to contend with. Something that has the potential to wipe all the rental income that you had received in years. So now, what do you do as a landlord to avoid that kind of drama and trauma? Do this. Make sure that you get to understand the difference between capital expenses and operating expenses. For operating expenses, they are the ones that do not increase the usability, functionality, and the capability of your building. They are mere maintaining and making the property to remain usable. So those expenses, recover them 100% in the same year of income that you have incurred them. But for capital expenses, the ones that are value enhancing, the ones that extend the useful life of the property, they increase the functionality and the capability of your apartment. Those ones you don't recover them 100% in the same year of income, but you recover them over time using the wear and tear mechanism. If it is not very clear to you, ensure to consult a tax expert who is conversant with all accounting rules and also understand KRA's expectations. So next time, when you are faced with a repair item, ask yourself, is this repair just maintaining the usability and the functionality of my apartment, or is it adding value? Is it extending the useful life of my property? Is it increasing the capability and the functionality of this building that I own? If the answer is about operating expenses, then recover it 100% in the year that you have incurred it. But if the answer is no, that they add value, they extend the useful life of your property, and that they enhance the functionality and the performance of your asset, then don't recover them 100% in that same year. Instead, use the mechanism that is provided under wear and tear deductions by KRA. So once you do that, you will protect your investment, you will protect your profits, and more importantly than anything else, you will protect the peace of your mind.